Your total today is $36.50. Will that be debit or credit? Well, that would depend on whether it is an asset, liability, or owner's equity account. When using T accounts, debits are recorded on the left side and credits are recorded on the right side. What do you mean? If the account is an asset, like cash or land, a debit will increase the account and a credit will decrease the account. If it is a liability or owner's equity account, like accounts payable or retained earnings, a debit will decrease the account and a credit will increase the account. The exception to these rules are called contra accounts. One contra account is the allowance for doubtful accounts, which increases with a credit and decreases with a debit, unlike the other asset accounts. But will you be using debit or credit right now? Oh, I forgot to tell you about expenses. Expenses are a temporary owner's equity account under retained earnings, and it has a normal debit balance. This means that a debit increases the account and a credit decreases the account. Dividends is also a temporary account under retained earnings with a normal debit balance. What? What is a temporary account? Temporary accounts are revenue, expenses, and dividends. All of these accounts fall under retained earnings and are closed out at the end of the accounting year. Expenses and dividend accounts are individually credited, and the retained earnings account is debited with their balance. The revenue account is also debited, and the retained earnings account is credited with that balance. So for this transaction, will you be using debit or credit? Well, if I pay in cash, your company would debit the cash account and credit the revenue account. Then you would credit the inventory account and debit the cost of goods sold expense account with the amount that this item costs the company to purchase. Ma'am, will you be paying with debit or credit? Wait, I have to tell you about the 4 different inventory cost flow methods: specific identification, FIFO, LIFO, and weighted average. A company can choose any method to use, but they must stick with that method to comply with GAAP's consistency principle. FIFO? LIFO? Weighted average? Specific identification? FIFO stands for first in, first out, and uses the price of the first purchase. LIFO stands for last in, first out, and uses the price of the most recent purchase. Weighted average is calculated by adding the total prices of each purchase together and dividing it by the total amount of items purchased. Specific identification is easy. It's when the company sets a specific price for the item. There's a line. Can you please pay me now? Will you be using debit or credit? Actually, I'll be using cash.